Morning and welcome to another webinar with AdviseWise. My name is Daniel Edmondson. I'm the National Account Manager here at AdviseWise. And today we're going to be talking all about lending past the age of 80. And we've got the Loughborough Building Society on with us today. Now, before I get on to formal introductions, introducing Ashley and the agenda in a bit more detail, I just wanted to go through some housekeeping. You would think after 2 years we'd be used to this Zoom session, webinar style approach to events, but just it's always worth doing a bit of a reminder. So mics, cameras, action. Mics, you've all joined with your microphones muted. As much as we welcome engagement, comments, questions, etc., just familiarise yourself with where the unmute and mute button is at the bottom of your screen, just to make sure that we're not disturbing anybody else on the session. Cameras, you've all started with your cameras off, but you're welcome to turn them on. It's great to see your smiley faces here on a Tuesday morning. But if your internet isn't too great at home, it does help with bandwidth, turning those off as well. When it comes to action, this is a webinar, but we can also treat this like a workshop. We're a nice intimate session, so we welcome people to utilize the chat box, as I've mentioned already, unmuting themselves and asking any questions. I can guarantee if you're thinking of a question, somebody else will benefit from the answer here today. We have got a range of delegates joining the call today as well, from very experienced later life advisors to perhaps more generalists that cover the mortgage market as well, to brand new advisors in the sections here today as well. So for Ashley and for anybody else that might be asking questions, do be conscious of that, because it will benefit a broad user base here on today's session. This session is being recorded. You can probably see the red flashing dot at the top of your screen. That means you will be able to refer back to it in the future. We will follow up with a link that you can watch back, that you can share with your colleagues, with your peers, and you will also gain those CPD certificates from this session as well. One thing that's consistent across all of our webinars, I always get at least one person the next day emailing me, asking me to send them their CPD certificate. We automate everything at AdviseWise. We're all about tech and efficiency. So you will receive an email by the end of the week that will have the recording on that's been edited, that will have the link to request your own CPD certificates, and contact information and any resources that Ashley, the speaker, would like to share with us today as well. So yeah, don't forget that, and there's no need to chase me tomorrow on that one as well. I will get on to passing you over to Ashley in just a brief second, but just to mention from AdviseWise's perspective, we've made loads of improvements over the last couple of weeks. More recently, and probably one to note, will be the cost calculator that we launched at the end of September. Now, the cost calculator, if you haven't seen it already, it sits at the bottom of your live sourcing screen. So when you're physically looking at your product results, you'll notice when you tick each product has a little tick box at the top. You can select a product and you can compare products. And now more recently, you can do a cost calculation. So in short, that tool is designed around building scenarios of the benefits of making payments, overpayments, interest payments, whatever the product setup is. It's to help you illustrate to a client the benefits of payments, limiting interest accrual, and showing them various different scenarios. It's fine having a conversation, physically saying to a client, if you can afford to make payments, would you? But actually showing them a graph of that, the limited interest accrual, or showing them a table of committed payments and the impact to the estate, the equity in the property. It really does help your recommendation. It bolsters out your pack and provides, more importantly, an audit trail to demonstrate that you've actually had those conversations. So please do check it out. It's a great tool, and it's one we've had an awful lot of traction on over the last couple of weeks. There has been various other sourcing and website improvements over the last week. You'll notice we rebranded our website at the start of last week, and then we are currently slowly implementing throughout this month various different sourcing and sorting filters on the platform to be all-encompassing of a whole of market later life sourcing platform. None of that would be possible without your feedback. So this is me asking you as a call, as a favor. If you notice anything, if you want something, if you think perhaps we're doing something not quite right, let us know. We pride ourselves in building AdviseWise based off of your feedback. All the calculations, all the tools, the filters come off your feedback. There may well be things that you ask that are unreasonable. We obviously take counsel on that and work out what's more suitable for everybody. But without your feedback, we don't know those ideas, right? So that's enough from me. I'm just going to slowly pass you over to Ashley and just reiterate the title and the learning objectives for today's session. So, lending past the age of 80 with Loughborough Building Society. Ashley Pearson is the head of intermediaries at Loughborough Building Society with over 7 years at Loughborough and over 19 years in mortgage services. Ashley, correct me if I'm wrong. And I did see from your LinkedIn this morning, there was a really nice cutout of a paper article. It reminds me when I go with my grandparents of some shocking statement of you going above and beyond for your clients.
That was some time ago. I was working at the Leeds Building Society at the time. I've got over sort of 20 years experience working for building society, so that's kind of my background. And within that, I remember that time the lady came in and she wanted to withdraw some cash, and it was looking a bit dodgy. The fact that she wanted £2,000 for some drains replacing, so we reported it, and there was the police came and arrested the people that were trying to scam the lady out of the money. So that was good. That was probably 20 years ago. Then I was quite young back in that photo,
Well,
and I didn't have grey hair then either, Dan.
Yeah, not to allude to your age, but it did say 23 in that article, and yeah, we won't go any more on that one. In terms of the learning objectives, then, so obviously, Loughborough Building Society cover a wide range of product types. We're going to look into their proposition in a little bit more detail, how retirement incomes are physically assessed when it comes to income affordability, and providing you solutions to complement the later life market. You know, things like RIOs and some of the other capital interest style mortgages, you know, they're just one of many tools for your toolkit, if you like. So hopefully by the end of the session, you'll have a great understanding of the many different product types that you can have in your arsenal to support your clients. But yeah, without further ado, over to Ashley to take us through today's session. Thank you.
Thank you, Dan, and good morning, everybody. As Dan's mentioned, I'm the head of intermediaries for the Loughborough Building Society. I work with a team of 4 individuals, so there's myself and 3 telephone BDMs with an array of experience over the years. So if you do need to contact us, you can contact us on our broker hotline and go through that. As a building society, we've been around for over 150 years. We're actually the 29th largest building society in the UK and growing. And we see later life lending as a real space where we can help complement the marketplace, as well as your equity release and your lifetime mortgage options out there. So what I'm going to do today is kind of go through our proposition and kind of talk you through. Okay, so most important thing with our proposition is realistically, it is not a RIO mortgage. Okay, let's get this quite straight out there. It's a regulated mortgage, and the best example I can explain with this is in theory, it is just a mortgage. That's what it is. So it's not a RIO, but you can have interest only, repayment, or part and part. Now, you might be familiar with the person on the left, but you may not be familiar with the person on the right. Now, the person on the right is a lady called Charlotte Hughes, who is actually the longest living person recorded in the UK at 115 years, 228 days. She originates from Hartlepool, and on her 110th birthday, she flew on Concorde. Now, you may be thinking, why are we telling me this? Well, reality is, and the reason for that is the fact that we have no age limit within this proposition. So we can lend to someone aged 65 for 40 years. We can lend to someone aged 80 for 40 years. We could lend to someone aged 115 for 40 years. Okay, so there is no age limit in the proposition at all. Now, just for a pub quiz, if you wanted to know who the oldest person in the world was, it was a French lady called Jean Colmen. It was actually 122 years. So you might want to make a note of that if you're going to a local pub quiz. Now, how does the actual proposition work from a loan to value point of view? Because there's sometimes a little bit of confusion when brokers first start using us. So in order to activate what I call the lending into retirement part of the policy, you have to take that mortgage past the age of 80. So if you took that mortgage up to the age of 80, then it falls into what we call our standard criteria. Whereas if you go past the age of 80, that's when you enter the lending in retirement space. And the maximum LTV we operate in that particular space is 60%. So 60% on interest only, repayment, or part and part. Now, once you go past the age of 80, we have no minimum equity requirements, okay, for interest only. So we're not saying, for example, someone's got a house worth 100,000 and they've got a £60,000 mortgage on it. We're not saying you have to be able to buy a house for 40,000 because there's very few of those about. Our sort of thought process around this really is the fact that if someone wanted to downsize, there's nothing really stopping them moving in with son or daughter in later in life. So that's why we've removed that particular part of the policy. So straight past the age of 80, there's no minimum equity required for interest only. You can set the mortgage up as joint tenancy or tenants in common. We've got no concerns about that. So if your clients wanted to, if they're sort of later in life and they've got children from other relationships, they can set the mortgage up as a tenants in common. In terms of the purpose, so the purpose of the loan, so what can we use the money for in terms of for a remortgage or purchase? But obviously if you're remortgaging, we can use the money for gifts. Okay, we could use the money to buy another property for a buy to let, invest in properties. We can do debt consolidation, and also we've made a slight tweak this year around savings and replenishing savings, because that was a common one what we started to receive, and we didn't used to be able to permit this type of lending. In terms of, you've got a lot of people out there that probably just want to have a nest egg to a rainy day funds. So we will allow you to actually do that. So in theory, anything legal, we would accept the purpose of the borrowing from capital raising up to the 60% loan to value route. Affordability. Now, obviously the mortgage is a regulated mortgage. So I'm just trying to point your attention to, because I'm conscious that there's some equity release advisors in the room and there's some advisors in the room and all different sort of array of sort of experiences. But from an affordability perspective, we are bound by MCOB, so the Mortgage Conduct of Sourcebook rules, in terms of how we assess affordability. So within there, we've got a couple of points. So when a lender looks at affordability, they have to look at the committed expenditure, they have to look at the basic living expenditure, and they obviously also look at the basic quality of living costs. Now, with the committed expenditure, that is something that can't be changed, such as loans and credit cards, etc., albeit they could change if they paid them off. Basic expenditure such as your gas, your water, electric, and your washing and your council tax can't really be changed too much because you've got to pay for them. But obviously with your living costs, they can be different because each person can spend money differently. Now, the majority of lenders out there, you will probably notice that they will use ONS in the background in an affordability calculator. With ourselves, if you went to our website, you'll see the affordability calculator and you'll see that we've actually pre-populated the ONS data. Now, we don't necessarily underwrite to ONS, but it gives us a guide. But what our calculator allows you to do, and is quite unique, is it allows you to change those figures within the affordability assessment. Now, when you do that, obviously you've got to prove factually from a bank statement that that person doesn't spend what it says for ONS. But the benefit to that from your perspective is it allows you to almost bespoke an affordability assessment. Now, the affordability also builds into the calculation that the applicant must have a 10% disposable income. So, for example, if they spent the gas, the water, electric, and all the other things expenditure, plus the mortgage, they must have 10% a buffer at the end. But the calculator also is quite good because you can actually submit it and it actually sends you a version of it to your email address. So you've got a PDF printout of what you've actually keyed in there for that perspective. So that's quite useful. I'm finding more and more advisors since we launched this sort of the last 6 months ago is using that, and it's really good for their paperwork and their fact-finding process. So on to the different types of income. So the different types of income that are acceptable. So we can accept state pension, we can accept PIP and disability living allowance in the affordability assessment. In terms of private pensions, so I'm going to break these down a little bit because I think these are quite unique in how we're assessing these as well. So if we talk about someone that may have a SIP pension, so we'll talk about someone that hasn't quite retired yet and then maybe is going to retire. So how we assess a SIP pension is basically we look for a valuation. So we're asking you for a valuation of the SIP. So for argument's sake, let's say the SIP is valued at £500,000. What would allow the applicant to do, and I'll use this word loosely, is self-certify what their intentions are going to be with that self-investment pension funds. So if I have a pension fund worth £500,000 and I'm going to draw £50,000 a year, then what we would say is, well, the maximum term you can have is a 10-year term, because our view is in 10 years' time, the money's then gone. So effectively, you're almost like asset slicing someone's pension. So what we require from the individual in those instances is we require a letter confirming what their intentions are going to be. And on the strength of that letter and the value of the fund, we use the income that they're stating they're going to draw. If they're already drawing from the SIP pension, so they might be retired already, we can still assess them that way, because ultimately they might be drawing £30,000 this year. They're then telling us, I'm going to draw £50,000 the following year. So again, we're going to use £50,000 in the affordability assessment when we're working this out. SAS pensions, so small self-administrated pension schemes, usually found for local family businesses. We can often find these they've bought probably commercial property within those. Again, it might be that that particular pension hasn't yet been crystallized. So in that particular instance, again, we take the same approach as a SIP. So you may have someone that's got a SAS with maybe £1 million in it, and we're going to take the same approach, even though that property hasn't been sold yet. So what we do there is we say, well, what's the amount you're going to withdraw? They sign a letter to say we're going to draw £50,000 a year as an example. And then we say, well, the maximum term you can have is a 20-year term. Drawdown pensions. So drawdown pensions, very similar. So it's a common theme here, how we're assessing these particular types of pensions. So with those types of pensions, if you have a drawdown, we're going to look at the value of the drawdown, and then we're going to ask the client, really, what are they going to draw each year? So if the client says we're going to draw £20,000 a year, okay, then they've got a £200,000 fund, then we're going to offer them a 10-year term as a maximum term. So we're looking at the value of the fund versus what their intentions are going to be. Things such as private pensions and annuities, slightly different with those, because obviously they may be drawing them or maybe looking to buy one in the future. If it's an annuity, we'll always go on the medium amount. So usually you have a low or 2, 4 or 6% growth. We're going to take the medium figure into the assessment when we're doing those particular pension funds, etc. Investment. So with investments, we can consider using investment income, and we'll consider using up to 50% of someone's investment income. We need to understand what type of investment it is. It could be a trust fund. It could be stocks and shares ISAs. I must point out we won't use something like a fixed rate savings bond as an income. We always look for something that is long-term investments, and we'll assess those and use up to 50% of those particular pension funds as well. Property income. So we will accept property income, and we'll accept that property income for the life of the mortgage. So we're not taking into consideration there may be mortgages that might be called back in the future. The reality is we will look at what's on the SA 302. So we'll look at land and property income, and we need a 2-year track record. If someone's got 3 or more properties, we'll use 100% of that land and property income that's been generated. Or if it's 2 or less, we'll only use 50% of that income that's been generated. Now, this particular space is really worth noting down. So what we're finding, I'm sure you are, is more and more people working later in life. For example, I remember a case we did not too long ago where a chap was getting his private pension, he was getting his state pension, and he was working 2 days a week at B&Q. And he was 70, I think he's 72, and he wanted a 20-year mortgage term, taking him all the way to 92. So obviously you think to yourself, well, you know, can he actually work in that shop until he's 92? Well, we took a pragmatic view and looked at it and thought, well, actually the balance of that mortgage is reducing. So in time, you know, that might benefit him in terms of where he could actually go with that particular mortgage. So he was quite comfortable lending to that individual. If we take, for example, someone that's maybe a limited company, a recent case we've actually done is where a chap, he was 74, he had a garage in Norwich, and what we always ask for when someone's a limited company is, can we see the accounts? And what we're looking at for the accounts is not necessarily what they're earning. Obviously, that's important. We're actually looking for how many people work for the firm. Now, within accounts, they will actually tell you how many people's work for the limited company within the financial year. Now, this individual had eight members of staff. So it's quite plausible that, you know, even if he got to 90 to 100 to 110, that he's probably not going to be going under the bonnets of these cars. And he's got people that's working for him at the garage. So our view was very much on the basis that, well, there's nothing stopping him sitting at home and taking salary and dividends whilst other people continue working with his business. Now, we've got to look at it slightly different for someone that's sole trader. Now, a sole trader, we'd probably look at somebody that, You know, if it was a bricklayer, it's probably not plausible that they could probably work till 80 and beyond. You know, there might be someone out there, I don't know, but generally we have to take a more sensible approach for those particular individuals. But if it's a plausible job, then we're quite usually comfortable taking income up to aged 80. And in other circumstances, like I just explained there, we can look at other things as well. Now, the big unique selling point with this proposition, and this is certainly worth writing down, we do not work on a sole survivor basis. So we do not work on first death. So if you've got someone, a joint applicants, and they're taking out this mortgage, we're not working out, well, if Mr. dies or Mrs. dies, where does that leave Mrs. and working on affordability based upon Mrs.'s income only or Mr.'s income only. Okay, so we're not assessing on that. We're not assessing on mortality rates. And that is a huge selling point for me as a lender. And hopefully you can see that that could really help your clients, particularly those some you may have turned away in the last 6 months. Now, it is important to state that they will need to receive independent legal advice. Okay, so if they're taking that mortgage past the age of 80, they will each need to seek independent legal advice, but that can be done via the solicitor. And what we actually do, we don't actually ask for evidence that legal advice has taken place. Once we receive the COT request, the offer states that once we receive the COT request, we are taking that as you have received independent legal advice. And obviously, the solicitor must obviously pick up on that offer condition, but that can be really helpful for those particular clients when you do struggle with a RIO type mortgages, where they will always work on the worst case scenario. In terms of this proposition, so we started doing lending in retirement about sort of 5 years ago, and this started to grow and grow and grow. And what we started to notice is we started to turn away clients that maybe had some credit issues and blips that were in later life. And we often find lots of clients that are coming to the end of the interest only period and have not actually got a repayment strategy, and we're able to help those. So we can help people that have actually got poor credit, even in this space, and even people in the 70s and 80s. And one that springs to mind was a lady that she was 73, and she was actually in an active IVA, so involuntary arrangement. So but basically what had happened, she split up from her husband later in life. She'd gone into an IVA because that was the only way she could deal with it from a financial point of view. And then she got into a position where she could manage her finances a lot better. So in that particular instance, we was able to help that individual. We was able to remortgage the mortgage, pay off the IVA to put her in a more a better position for her going forward. But again, if you've got clients that have got unsatisfied defaults or CCJs, I must add CCJs is up to a maximum of 1,000, then again, don't write them off, because it is something we can do. We do these by referral, okay, and there is a specific product which we call the Prime Plus One product, which these particular individuals can be placed upon, but obviously it provides them help with a solution. I'm just going to take you back to lending in retirement piece, because I think if you can all see this, it's quite interesting how we're calculating things. So I've put on the screen here a scenario, and the scenario is we've got an applicant that we'll call it they're currently working, okay, and they are 65 years of age. Now, what's happening here is that they're earning £25,000 a year. They've got a monthly loan of 100,000, and they've got credit card balances of 1,000. And this is where I think this could help you in terms of what I would call it parking the bus, particularly around equity release, because my understanding is I'm not an equity release expert, but my understanding is often if you're younger you are, the less you can borrow, but obviously the older you are, the more you can borrow. Now, often you might find clients that are not quite ready to equity release, or it is not a solution that is right there for right now. So what this can help you with is, like I said, parking the bus. So this scenario is where the applicants are earning 25,000, they've got a loan of 100, and they've got credit cards of 1,000. So the affordability here, so at the outset, is affordable, okay, based upon their income. And what we're then doing is working out, well, when are they going to retire, or when are they going to reach the age of 80? So these particular individuals are working until the age of 75. And what the calculator does is it works out what is the balance of that mortgage going to be in 10 years' time, okay? And then really, what is their anticipated retirement income going to be at the point they retire? Now, you can see here, it might have been that this individual wanted an interest-only mortgage. Now, obviously, with an interest-only mortgage, the balance will never change. However, with a part and part mortgage, what you can do is set it up so that you've got here 65,000 on repayment and £35,000 on interest only. And what's happening is calculating at the time they retire, will this mortgage be affordable on their retirement income? And if the answer is yes, which this one particular is, then this particular person could have this mortgage up to age 90. But it really does make you think about, well, those people that are on interest-only mortgages now coming to the end and have got no repayment strategy, that are not quite ready for the equity release. Is this a solution to park the bus and revisit in a few years' time? Now, we have around about sort of 4 products in this particular area. Our most popular product, if I'm honest, is our term discount product. The term discount has no fee, free valuation. It's always had that for the last 5 years. But the key selling point as well is it's got no ERCs on it either. Okay, so it's a discount off our variable rate with no ERCs, free val, no app fee. So again, it's probably 70% of our cases are placed on this particular space on that particular product, because it gives you that flexibility to revisit whenever you wish. So the affordability calculator, you'll find that particular one I just showed you previously, that's an internal calculator that I've just been using. But if you visit our affordability calculator online, you complete the calculator as normal, and at the bottom there is a part, so if you're doing a repayment mortgage or part and part, where you would input how many years it's until they retire or aged 80, and it'll work out the balance for you at that point. You then pop in there the retirement income, and then it works out the projected income multiple, which we can't exceed 4.5, so it's always going to be 4.5. I would add that if the applicant is already aged 80 or older, the maximum income multiple we'll do there is 3.5 times. So before aged 80, it's 4.5 times. After aged 80, 3.5 at application, that is. So what other solutions have we got? Because I'm conscious that, you know, we've got that particular solution there, but there may be other avenues you could explore. So for example, let's say the applicants are struggling with affordability. So you've looked at this and affordability isn't an issue. We can actually offer a joint borrower sole proprietor mortgage for lending in retirement. So this would be where son or daughter would go on the mortgage, but not on the deeds, and we'd use son or daughter's income, or jointly, because we can have up to 4 people on a JBSP, and we'd use their income in the affordability assessment, and then we'd base the term of the mortgage based on the son or daughter's age. So theoretically, again, they can do a 40-year term, and again, that could be on interest only as well. But the property itself would stay in the hands of the parents, but the mortgage would be supported by son or daughter. The last one I'll mention here is around our family buy-to-let mortgage. Now, I probably do one of these every month now, and this is where, for example, let's say mum and dad have got an interest-only mortgage and they have no way of repaying that mortgage. What we allow you to do is actually gift that property to son or daughter, and son or daughter rent it back to them on what's called a regulated buy-to-let. Now, mum and dad would need to seek independent legal advice, because they need to be fully aware that they'll have no equitable interest in that property. There are things like stamp duty and tax implications for high HT, but ultimately what it allows the parents to do is remain in that property. Now, when that does happen from an affordability assessment, what we do is we assess the rental income they're going to charge the parents. Now, in these instances, it wouldn't seem plausible to charge mum and dad the going rate to live there, having given the house to son and daughter. But we would be quite comfortable if the actual rental income was the mortgage payment in the assessment. So in that instance, we'd use the rental income, also the mortgage payment being paid by mum and dad, and top slice son or daughter's income. But again, it's another avenue to try and help that individual stay in that property. So hopefully going through that today has given you a flavour of some of the things that the Loughborough can offer. And now I'll kind of open the floor to some questions.
Hi Ashley, it's Lauren at Meridian.
How are you doing? You all right?
Good, thank you. I've just popped on the question because when you're talking about joint borrower sole proprietor, you mentioned sons and daughters. Is that the only option for joint borrower sole proprietor, or could it be like grandchildren or wider relatives?
Yeah, it could be grandchildren. It can be any family related person, I suppose, can support them, provided that they are related. But yeah, it's an option where we can go up to again 60% loan to value, and we're using the lending in retirement policy coupled with the JBSP policy, but it allows that individual obviously to support the mum and dad.
Cool, thank you.
That was great question, and thanks for jumping on that. Thanks for your contribution there, Lauren. And just whilst we've got the chat box open, and just to make sure everybody has got the chat box open, if you go to the bottom of your screen, you see the little chat button opens up the box to your right hand side. I have been putting some links in whilst Ashley's been speaking, both of the Loughborough's website, to their intermediary website, and also to AdviseWise's website as well. Whilst you're all thinking of questions, because I do want to ask the audience here in a way of, think of some questions. Let's get some engagement going and treat this as a workshop. But whilst we're doing that, can I just get a virtual show of hands by commenting yes in the chat box if you have either engaged with the Loughborough before, registered with the Loughborough before, or physically done an application with them in the last 12 months. So just a virtual yes show of hands, or no. Thanks, John. Just one. I want to try and get you to open your chat box so we can all see everyone's questions. And Lauren loves the Loughborough, thank you. And two, it just makes me make sure that everybody's awake on this call as well. So lots of no's, which is fine. Leads on to the next question. So if I'm not registered with the Loughborough, Ashley, how do I go about doing that? Who can I lean on as an advisor when it comes to development support, lender support?
You can contact myself. I'm quite accessible. Hopefully the people that do deal with me usually can get hold of me, believe it or not, for a BDM. So I cover kind of all of England and Wales. Okay, so I'm the only sort of on the road BDM, as we call it. But in the background, we've got Luke Berrington, who's our senior telephone BDM, and we've got Jazz Meat and Stuart are our telephone BDMs as well. So there's a team of 4 of those. There's an email address. You can email us at brokers@theloughborough.co.uk. We've got a broker telephone number that you can contact us, and myself and Luke have also got mobile numbers. So if you needed that support, we often certainly when a broker registered with us, we try to engage with them early doors in terms of understanding the case, and we can quite happily talk them through the proposition or our affordability assessment, how we're going to do that. But if you wanted to register with Loughborough, you can find our details on our website with panel registrations on there. In terms of our systems, so this is probably worth mentioning, Dan. So our systems will be changing in sort of January. We're currently going through a trial period at the minute with, if people that are on the call that are familiar with the mortgage world, we are currently partnering with MSO. So if you've used the likes of Accord and those types of lenders, we've actually moved on to that particular platform. And all of the calculations, which is quite clever really, is when you key in someone's income and age, and then you put when they retire, the actual decision engine within the system works out what the balance will be as part of that decision. So though we might be seen as a relatively small building society, we are investing heavily in technology that we believe will help us and help the proposition, but also not only that, help you as intermediaries.
Yeah, it's great. That's really reassuring to hear as well. Thank you, Ashley. One comment from the chat box as well, and that might help us segue on to any future developments or innovations on the products. Emma tells you that you need to lend in Scotland. She's got a case for you right now.
Yeah, I'll never say never. My wife's actually Scottish as well, so she'd probably roll at me for not lending in Scotland. But no, thank you very much for Emma. Sorry we can't help you in Scotland at the minute. It is something we're always looking at refining the proposition. We're always changing things, and the biggest thing is feedback from brokers. And I'll often pick the phone up to brokers that use us regularly and say, if there's something we could change within reason, what could we do? But I know there's not a huge amount of sort of lenders that operate in the Scottish market, but it's good to know that there's a case there if I wanted it. Then Emma,
good stuff. And just as a reminder again, please pop some questions in the chat, any comments or feedback. If you've had a successful case with the Loughborough, then let everybody know in the chat box as well, because that's really useful. Just another question from me, please, Ashley, is what for the benefit of Any of the delegates on the call that are part of or predominantly later life and doing equity release, maybe you're an equity release specialist advisor or it builds the bulk of your proposition. At the moment, we're experiencing rates going up. And I can assure you from a sourcing platform, we're experiencing rates going up, right? You can thank the budget for that the other week. You can thank the US election providing a little bit of uncertainty. But a lot of the lifetime lenders fund themselves based off of the gilt market, so the long-term gilts. So what my first part of the question is, what do your rates look like? I know you need to be careful about advertising specific rates, but in what range are they sitting at the moment? One challenge that we have when it comes to customers engaging with later life advisors is, they see a base rate reduction, as we had the other week, which is all positive, and then they end up speaking to a lifetime mortgage provider or a later life advisor, and rates are then starting with a 7 or an 8. I know headline rates for equity release are a little bit cheaper than that, but when you've got mortgage rates starting at a 3 with 3 and 5 year fixes at the bottom end of the scale, and then you've got base rate reducing, it's quite hard to digest when you're coming into later life propositions when they're quite high. So yeah, where are your rates at the moment, and how are you funded?
So because we feel the later life space is really good for us, we've actually got our lowest rate is actually in the later life space at the moment. So we have a 3-year fixed at 4.99%. Okay, which is in that particular case. And when you look at the other opportunities within there, we have, it generally filters around about the 5.5. Okay, the term discount one, which is the most popular, is at 5.79. Now our SVR, obviously our SVR doesn't necessarily track the Bank of England. So as a lender and as a building society, we move that up, determined by what we decide really. Now, as an example, if you think the rates started to go up in December 2021, when Liz Truss was in power for that short period of time, I think we was one of the lowest lenders to increase our SVR. So we moved our SVR up by 2.15 in that 2-year period, when other lenders are actually moving it up with the base rate. Okay, so our track record in increasing the SVR is really good, and I was sending out a lot of data to our key panel members to say, look, don't discount a discount mortgage, from that perspective. Now, the other thing with our discount mortgage as well, even if you didn't take out a term discount product, we've actually changed our ERCs. So if you took out, say, a 2-year discount with us, the ERC on that would only be 0.5% in the first year and 0.25 in the second. Again, very different to the market, because most of them will use 3 and 2% as an example. The majority of, I'd say 99% of our funding is coming from retail funds. We're not buying from the bond markets. We are getting that through the door through savers, that are investing with us. But as everybody, it is quite a competitive market, even for building societies like ourselves. And we particularly usually do well in things like the bond market or the ISA markets to obtain that funding, but very safe and secure.
Awesome, thank you. That's great. That's a really good answer. And we've got quite a few fans in the chat box, by the way. Emma, thank you for that one, and Louise. I'm sure Ashley will be contacting you afterwards to see if you can put that on Trustpilot or Google or something. Something like that. But no, there's some great questions answered. Another question for me, and again, reminder to the chat box, if you do have any questions, if you're unsure, don't feel like any question is going to be silly here, right? There's lots of people on the call that will be feeling the same. When it comes to assessing future affordability, so obviously it's fine doing income and affordability right now. My clients, what is this? My regular income is this. And you mentioned about, you're not working on first death and mortality. Looking at somebody's changing circumstances or a change in circumstances, you've got the ERC free product, which doesn't really penalize. It makes it a lot more short term. But are there any strong views on assessment of future affordability? So any key considerations for advisors to take away?
I suppose from your perspective, you might want to think about things like putting a life insurance policy in place to cover that, particularly if something is one person is earning so much money and the other person isn't, then there's that weight. And theoretically, yes, you could have, example, you could have Mr. having a pension of £40,000 and Mrs. having a pension of £10,000. Now, clearly, if Mr. passes away and she doesn't receive any benefits from that pension, then she's left on an income of 10,000. Now, that's why the I suppose the independent legal advice is there to make sure the applicants are fully aware of the consequences, I suppose. And that's the way we protect ourselves. I mean, It is unusual for a lender to take this approach. I've often asked the question, it's kind of down to our risk appetite in terms of what we want to do and what we're prepared to do. And we think this is kind of a bit of an unserviced market. So again, when we looked at this proposition, we looked at kind of the Rio lenders and what other lenders were doing, and we wanted to be slightly unique. But it's something you need to have a conversation with your clients about, clearly. But from that perspective, it might be, like I said before, this is a short-term measure, for particularly people that work in the equity release market, where you might look at this as a parking the bus, as I mentioned before, and revisiting later when they can actually borrow more on equity release.
Yeah, and that's a phrase I've heard a few times, not just on this webinar, but over the last couple of years, is parking the bus or kicking the proverbial can of equity release down the road a little bit. And I know those products are becoming increasingly more flexible, but in the right circumstances, these products really do shine bright for those clients with an income that require flexibility and also don't want to be committed into a lifetime mortgage. They want to be on a specific term or something along those sorts of lines. But yeah, it's really reassuring. And then to badge that up with, there's lots of advisors that I deal with in my role at AdviseWise that only specialize in one product set. And that's fine if they're referring those clients on. But you can see where the opportunity arises to anybody that perhaps has a client bank of unserviced clients perhaps that are not meeting the qualifying age for, say, an equity release, or perhaps have significant income, weren't open to those higher rates, or don't have an appetite for a rate starts with an 8. So it's worth assessing those opportunities and seeing if you can write that business yourself, if you're capable of doing so, or mail into that database and letting them know that these are viable opportunities. Having the regulated buy-to-let, being able to rent that back to the loved ones whilst they're still living in the property, having the joint borrower sole proprietor. There was a question in there, I believe, on joint borrower. Oh,
I think Lauren asked it. Yeah,
that didn't. But I noted it down, but didn't. But yeah, it's super flexible. And then when you bridge that up with we are an aging population. In the UK, it's great to see that we've got to 115 as the age, but then in the world 120, and I can see those stats in the future not going crazy high, but continually improving. The UK's over 55s population is expected to rise by 20% in the next 10 years. And that's data from the Office of National Statistics. The regulator, within their outputs a couple of weeks ago, really have it in their priority list over the coming years to make sure that we're advising and we're making a provision for income into later life. We're having lots of people, this is a common conversation, is people are retiring or getting into later life asset rich and cash poor, and they are in need of later life solutions. So the whole point of this webinar from AdviseWise's perspective is to, give you another tool for the toolkit, to give you another lender, another contact to engage with to find suitable solutions for your clients. So yeah, there's lots to digest there. Hopefully everybody's made some notes, some comments, and I have some questions as well, be that if we take some offline. But yeah, and Tracy, thanks for your comment just there as well. New to Loughborough, you can see how useful it is for parking the bus. Because don't forget, as an advisor, if you do an interest-only mortgage or a fixed term for a period of time, you've not lost that client. You've just quite literally kicked the can down the road for them, so you can re-engage with them and retransact with them in a few years' time. Whereas often people will default to a lifetime mortgage and perhaps never see that client or speak to that client again, which is an awful shame. So yeah, appreciate the comments there as well. Question from Louise here: can clients go direct to Loughborough, or do they have to go via an advisor?
They can go direct. We have a small sales team of 3 advisors, so if they did want to contact us directly, they could do, yes.
Good question. Great question. Any other questions?
I'd rather it come through brokers, though, to be honest.
Any other questions from the chat, from the delegates? We'll give you a few seconds just there, and just whilst we're waiting, if any do come through, Ashley, do you have any points in closing?
No, not really. I mean, thank you very much for the opportunity, and thank you for everyone that's attended today. And it's just to recap the key points, really. The fact that we have no age limit, there's no minimum equity requirement. We're not working on a sole survivor basis, and again, reiterating that part the bus opportunity that potentially is there. But hopefully, we've given you a few solutions today that you can take away and add, like Dan said, to your toolbox, really.
Great stuff. Great stuff. So it feels like we're coming to a natural end. I've just put a link to our events calendar for any other CPD opportunities that you might want to jump on and take advantage of. There's lots of things happening in the market over the next few weeks. Towards the end of the year, it feels like a bit of a hotspot time for the diary for events and webinars. So go and check that link out. They're not just our own events, they're events from lots of different parties around financial services. So Financial Reporter, Morgan Ash on vulnerability, the Equity Release Council, and they're having their Later Life Summit on the 19th of November. There's the Mortgage and Protection Summit tomorrow with the Financial Reporter, and then there's loads of on-demand content, including some stuff on valuations from Aviva. I would recommend that. It's quite a well-attended and engaged event, is the Valuations Unlocked. But in closing, from me, I just want to take an opportunity to thank you all for joining us on this call this morning. Thank you to Ashley for taking us through the Loughborough proposition and the wider learning objectives. As a reminder, as I said at the start of this call, this is going to be a CPD recognised webinar. You will get an email follow-up with us with a link to watch the recording and pass on a recording if you want to. You can request your own CPD certificates. Remember, no need to chase me tomorrow, and then watch out for more events from AdviseWise. You can book a demo. If you're not registered with AdviseWise, I would encourage you to do so. It's a completely free to use later life sourcing platform, and obviously it hosts products such as the Loughborough and various other RIO, capital interest, interest servicing, payment term, lifetime mortgages. There's so many acronyms now with these products, it's getting quite confusing. And we're here to support you in that as well when it comes to our help desk, our mortgage club, and so on. So yeah, absolutely thank you all for your time today. Have a great Tuesday, have a great rest of the week, and we are, I'm gonna say it, we're 43 days until Christmas now. I'm pretty sure. I hope none of you have got your Christmas tree up yet, but I'm sure it won't be long.
Thank you.
But yeah, thank you all guys. You're free to jump off.